What is up, everybody? Welcome back to the Dentists Who Invest podcast, a much requested episode on ESG investing. It's about time we did something about this topic because a lot of people ask me about it, and I've got in the house expert today, Jon Doyle, stood here in front of me, who is an FA. How are you, my friend?
I'm very well, thank you. I'm very well. Yeah. How you doing?
I'm smashing, my friend. And you know what? This episode today, I'm here to learn as well because I know what ESG investing is, but by my own admission, I haven't done nearly enough research into it. So, Jon, maybe it might be nice for you to do just a quick intro about yourself, and then we'll jump straight into ESG investing, what it is, how does it work, and how do we take it into consideration when we're designing our portfolios.
Superb. Yep. So as you said, my name is Jon Doyle. I'm an independent financial planner. I run a company called Juniper Wealth Management. We're based up in Lancashire, but as you can probably tell from my voice, I'm a southern lad. Grew up in the New Forest. Daddy was a dentist, hence working with dentists as well. So 14 years now as a financial advisor, working in not only traditional investing, but ethical and socially responsible and ESG environment. And it's something probably about 60% of our clients have some form of ESG integration in their portfolios these days.
Gotcha. And on that note, ESG, let's break it down like you're explaining it to a 5-year-old. Bear in mind, you're talking to us dentists who have no financial background whatsoever. ESG, what is it? Let's start from the bottom up.
Okay, well, probably best to start with a bit of history. Okay, because there's a lot of terms, and I realized I just threw a load of terms in, even in my introduction, right? So
Cool.
if we go like all the way back to the 1960s with investing, people's main intention was just to make money. I call this traditional investing. Okay, but then you had a few kind of charities or very, very ultra high net worth investors who wanted to not invest in certain things, mostly for religious reasons. And we had the birth of ethical investing or socially responsible investing. And then as you flash forward to about 2005, the United Nations came up with this governance policy called ESG. Okay, and that's where this kind of middle ground starts to come in. And as advisors, often we conflate all the different words together, but they do mean different things. So ESG is environmental, social, and governance. And it's a way of looking at a company and giving it a score or a rating based upon its impact on the environment, its impact on society, and its governance as a company, so how well it's run.
Got you. Interesting stuff. Okay, cool. So how does that conversation typically go when you're consulting a new client and they say to you, okay, Jon, what I want to do is I want to have some sort of ESG consideration in my portfolio. What would you in turn say to them next? Would you say, okay, well, I would advise you to go partly ESG, partly traditional? Because what I would assume is that the returns are better if you have a diversified portfolio across more traditional markets rather than ring fencing yourself into one particular subsection. Would that be the case, or how does that typically look? Or would you say full steam ahead, ESG is where it's at these days, that's where you're going to get the best returns?
So in terms of do they return better, because that's probably the easiest one to answer. What I've tended to find is they kind of zig and zag. So when one's outperforming, the other will lag a bit, and then you get this crossover. Mostly because you, with ESG, you'll tend to filter out sectors like oil and gas or tobacco and things like that. They'll tend to not be in there. Now, if you look at the last, so 2020, ESG portfolios absolutely flying because it's filled with tech stocks, it's filled with Tesla, it's filled with Google and all these big companies. But then over maybe the last 12 months, as oil and gas prices, well, we all know what's happened with those. You've seen the sort of traditional investments claw back and maybe overtake. And so I find it's a bit of give and take, which is why my question comes more onto what values are we trying to achieve with ESG? Okay, so our investments it's about aligning values with your money, because for some people it's really, really important. Maybe there's like serious ethical considerations they've got. So they're really far on the spectrum. They're living a vegan life, completely at one, harmonious and hippie and tree hugging and everything. For others, it's actually, I just want my money to do some good. I just want to feel like I'm not making the world worse than when I joined it. For others, just absolutely no real consideration. We just continue with traditional. So we have a big conversation around values and what it is we're trying to achieve with investing, maybe with a socially responsible or an ESG hat on.
Well, yeah, that's completely reasonable, because I suppose people might come to you and they say they've heard of ESG and they say, oh, well, that sounds good. I want to partake in that. But actually, what ESG means to one person is totally different to the next person. So I'm really interested actually. So how does that conversation look then? So you'd ask them specifically about their religious beliefs, how do you quantify how ESG someone is,
We have two approaches to this. We've got one that's sort of stipulated from a regulatory point of view, where we give our clients yet another questionnaire to fill in, and they tick all the boxes. And that can be useful because you can see, they're really concerned about animal testing, or they're concerned about, alcohol. But then you have this wider conversation. I've got a whole slide deck that I take clients through. Big part of it's about educating them why we invest the way we do, why we do the things we do. And I've got what I call a Venn diagram on steroids of where all these different areas overlap with each other. Because the surprising thing for a lot of people is that an ESG portfolio has most of the same investments as a traditional. And it's just the fringes of the companies that you're kind of getting rid of. The bad actors, as it were, is what you're trying to achieve anyway. And so you can talk to people about, well, is there somewhere along this spectrum that you feel that you're landing on? Are there specific things that you're really against, or is it just a general approach that you're trying to take here? Sometimes you'll get someone who just turns around and says, in one conversation I had, they were like, I don't want to invest in Boohoo.
Okay.
And you're like, okay. It's actually a practice manager at a dental practice, this one. I don't want to invest in Boohoo. So you go and have a conversation. You go, well, the amount of money we're investing, the cost of implementing a portfolio that only excludes Boohoo is not going to provide you any value from an investment perspective.
I hear you. Yeah, and presumably that's Boohoo because of fast fashion.
Yeah, and the whole controversy during lockdown of paying people £3 an hour in Leicester and all this kind of stuff. Just not a great company. But we use index funds a lot, and we'll talk about indexing and ESG, I'm sure, later. But I'll then approach it with that conversation. If we've got a portfolio with, say, 5,000 or 6,000 investments in it, and one of those is Boohoo, and you've got 100 grand invested, what are we going to have invested in Boohoo? £1, £2? How comfortable are you with that if we know that generally we're taking a approach where we've got good companies for the environment, good companies socially, good companies on the governance side, if one or two slip through?
Got you. So it's a conversation, effectively.
It's definitely a conversation. Yeah, and different people have different abilities to bespoke it. We do some work with charities. We've got a multi-million-pound portfolio for a charity. We're able to go very specific for that charity, on what, because we can individually screen things out because of the size of the portfolio. And then they've got the social risk of, that charity invested in bad lending practices, not very good because the charity is kind of trying to help people out of poverty. So gets very important on those things. Yeah.
Yeah, I can imagine it's a PR thing. Absolutely. So who's on the naughty list when it comes to ESG investing? Who are the no-nos, the people that are blacklisted and they'll never ever be in an ESG portfolio?
That's a really, really interesting question, because There's some surprising companies who are in ESG portfolios. Okay, so you might think that an oil company would never hit an ESG portfolio.
Yeah,
But if I
that would be a reasonable assumption. That's actually who I was thinking of when I asked that question.
so Shell have a double A rating for ESG.
Oh,
Yeah,
oh wow.
yeah, it is the most surprising one. There's a great tool, and send you a link so you can put it in your show notes. But we use MSCI, and MSCI are a big index provider. We use their methodology for our ESG and socially responsible portfolios, and they've got a tool you can go and you can look up any company that's listed in the world and look at their ratings and what's going, why they're rated the way they are. Shell have got a really good climate impact target, and they're on target to hit that 2.5-degree increase on climate change, decarbonize. And then they've also got really good governance, really good corporate behavior. So Shell actually end up as double A, higher rated than Tesla.
Really? Okay, wow. So it's not as intuitive as you might think, or it's definitely not like these people are bad, this industry's bad, this industry's good, something like that. And just to clarify, double A, I'm guessing like the best rating is like triple A or something like that.
Yeah.
So they're one off the top. And then what is the rating? What do the ratings go down to? Like
Like
E, F,
C.
C. Okay. All right. So it's okay. Wasn't expecting that from Shell, but there you go. And well, I have read a little bit about them that they do plant like X number of trees for every well that they find or something like that. There's some sort of
It's
metric.
those sorts of things, carbon
Yeah.
capture, carbon offset, investment in renewables. They're going to be making strides towards hitting climate targets. Yeah.
Got you. Okay. Let's look at the cold hard numbers, and we touched upon this a little bit earlier. Is that you said that obviously tech in like what 2019 2020 was flipping booming like the Nasdaq and what have you. Yeah. Nowadays, over the last year or two, less so. But then again, in investing terms, those are tiny time frames, like really small time frames. Okay. So overall, is the data there yet to say that ESG can actually outperform traditional investing or just buying the stock market, buying the market?
No, is the honest answer. That there isn't enough data yet for uh, to show that ESG is like a factor in the same way like small cap or value investing or growth investing would be a factor that you could look at and say, yeah, academically speaking, it will produce outperformance. There isn't that data there yet.
Yeah, I thought you might say that because it's only really, I'm guessing a lot of these funds have only really been around for maybe, I don't know, under a decade.
Yeah, so if you think sort of 2005, the UN came up with the phrase ESG.
Yeah.
It takes a few years for it to start filtering through, and then yeah, you most of these funds, this fund management industry is classic for this. They launch them when it's popular. So like if you look at where the money's come from, it's like mostly in the last 2-3 years. So there just isn't that sort of data. Probably the best one to look at if you're looking for long-term data is the FTSE for Good, which was sort of launched in the early 90s, I think. That was more ethical than ESG, but there's obviously a big overlap. Yeah, so the FTSE for Good could be quite an interesting one to look at.
That's interesting. And FTSE for Good, I'm guessing, I'm reading between the lines and I'm going to say that that's a tracker fund.
They have a range of tracker funds with the FTSE for Good. Yeah,
Right.
yeah,
Right. Because obviously that would mean that it's not active, which would mean the fees are less, which is,
yeah.
you presume most ESG ones are active, right? Well, I'm guessing that they are.
It's as with funds in general, most funds out there are active, but there are an increasing number of ESG and SRI, socially responsible index funds out there. So the portfolios we run at Juniper are all index funds, both the socially responsible ESG and the traditional.
That's okay. So I've just heard you, I've just picked up on you using another term there, socially responsible versus ESG. And I'm going to guess there's some slight difference that sets those two apart. There's some distinction in there.
Yes. Yeah. So ESG is where you just get rid of the bad actors, but then socially responsible, you're saying, well, there's certain things I just don't want to invest in. Now, mostly with those, it's the kind of the popular sins. You know, you've got tobacco, you've got oil and gas, you've got guns. You know, those sorts of things would get screened out. Alcohol's generally thrown in there as well. So things that are kind of seen as the most common things people want to be out of, and then you get a socially responsible portfolio.
That's interesting. So when you obviously we can't go into specifics and tailored advice in this podcast, but when someone comes to you as an individual, as a client for your services at your financial advisor, your company, would you ever say to them, listen, would you ever actively say, listen, I think that you should at least have some of your portfolio in ESG, an ESG based one because of X, Y, and Z? Or is it more a client-led discussion that you let them come to you and ask, actually, this is what I'd prefer to have? Or would you ever guide them into investing in those things from the point of view that you genuinely think that they can maybe get better returns, or part of their portfolio should be in this for whatever reason? How does that look?
So my default is to go one foot in both camps. Just
Okay.
of, you know, let's split 50-50 between a socially responsible and a traditional approach.
Oh, really? So that's actually your default for a new client? That's
Yeah, because
interesting.
when I speak to most people, they go, well, I kind of think it'd be a good idea, but I don't want to lose out. And, you know, I don't, they're kind of middling about it anyway.
Yeah.
And if you're kind of undecided and you go, well, I'd like a bit, but I don't want it all, then 50-50 seems like a reasonable approach to take. It kind of, it's actually worked really well over the last couple of years because it's evened out the outperformance and underperformance of the two portfolios. You'll find a lot of our advisors will argue about this, and I'm sure there'll some tell me I'm I'm wrong. But you know, what we then tend to do is based on the conversations is we'll weight it one way or the other. So I've had some clients who'll turn around and say, you know, I don't want any of that. It's all hippie nonsense and
Mm.
all traditional. And then others who will go, yeah, it's really important to me, and will go full socially responsible. But yeah, the one foot in each camp kind of, yeah, seems to be quite comfortable. It's the compromise approach, I guess.
That's cool. That's interesting. And I know we said the data wasn't there just at the start to say what the returns are going to be on these long term. But are you able to pluck some numbers off the top of your head in terms of average returns? Say for that the FTSE one that you were talking about earlier, how much is it appreciated on average every year? And I get that the time frame is not long enough for us to say what that might be going forward. But let's compare it to the S&P, which is what, like 9.1% total returns if you include dividends.
What I'll
I'm just
do,
really curious.
yeah, if you give me just 2 secs, I'm just going to
We
pull
can
up.
pull those. Yeah,
Yeah,
yeah.
what I'll
Because
do is I'll pull up the portfolios that we use, and we'll
yeah,
just look at the 100% equity, because if we're comparing to the S&P, then 100% equity is where we'd want to be looking.
yeah, totally. That would be really interesting to know. But just as I say, just to reiterate what we said earlier, anybody who's listening to this, it's not the only metric to make a flipping investment decision on what it's done.
Yeah.
And I actually see this all the time, that people see returns as the only metric, but really there's a lot more to it. But I'm just genuinely curious, just straight up, how that compares or how that
Yeah.
looks.
So these portfolios have the same asset allocation as in global asset allocation.
Mm-hmm.
Okay. And the same equity allocation. It's 100% equity, but if we're America, it's, you know, the same percentage is allocated to the US. So if we look at 5 years,
Mm-hmm.
on the socially responsible, the return has been 10.28% per year
Okay. That's
after
competitive.
investment costs, but before any advisory costs. And then for the traditional, it's been 7.07
Okay, interesting.
for that same period. And And largely, like I said, largely that's down to the responsible having a higher weighting to tech, which over the last 5 years has done particularly well, versus sort of more traditional weightings to oil and gas and other things. So it's to the weighting has been favourable over this last few years, but 5 years is not enough to say this is a repeatable pattern going forward.
Yeah, totally. And is there any data on that over longer time frames, maybe 10 years, something like that?
I don't have any for the portfolios that we run because those indexes that are within it and the funds haven't been around that long.
Cool. Yeah.
But I probably, if we you fill for a moment, I can jump into this.
Absolutely. Yeah, absolutely. So, yeah, I mean, ESG investing, I'm here to learn as well on this particular one. And it's one that gets requested on the group an absolute ton. And I feel like for me, what the whole point of this podcast is, part of it is to actually delve down into the nitty gritty, because I feel like there's going to be two camps out there. There's going to be the people who see it as something hugely important. However, they're also a little unsure because they don't know, is this going to compromise their actual returns to some degree, which, this is why we're delving into the returns here at this point. But we're also quick to caveat everything and say, listen, the reality is the timeframes are not long enough to really draw any serious conclusions. So whilst, yes, let's look at it straight up from the point of view of people who want their portfolios to grow at the greatest rate, maybe it does make sense. Okay, maybe it does make sense to have some ESG, but at the same time, would you want to put all of your wealth into it at this stage? Probably not, but it maybe actually makes sense even from the point of view of someone who just wants to accelerate growth in their portfolio and actually get better returns.
I think I would expect it to pick up similar returns to the index as a whole. Mm-hmm. Because, when you're talking about how many companies are going to be held within an index compared, those that would be filtered out on ESG, you're not going to be screening out loads and loads of the market. But what you'll have is pockets of performance where certain sectors will be outperforming or lagging, and that's where you'll get your difference. But over time, that will generally even out.
Cool.
And more companies are starting to produce the information that ESG rating companies want and also produce the target. So more and more companies will be getting pulled into the ESG rating system.
Yeah.
I'm just looking through.
Oh, okay.
I haven't got anything long enough that I can find quickly.
It's all right. Maybe, maybe even if we would just straight up be able to see the returns of that one that you mentioned earlier, the FTSE one that I can't remember exactly.
FTSE for good.
FTSE for good. That's an interesting one. Yeah. Maybe that might be the best place to go. And then what we do is the average total returns, I suppose, on that. It would be interesting. But I mean, yeah, we'll see what we find on that one.
Okay.
Let's see what we find. What we'll do is we'll just cut this bit out.
Yeah, sure. I think the well, if we're cutting this bit, then that's fine. I can just take a moment just to find something.
Is there anything else? Obviously, we're going to cut all this part out.
Yeah.
Is there anything else really do you think that is worth me asking you about?
Yeah, I think so. I think one of the things that's a really interesting discussion at the moment is what is ESG actually doing to improve the companies that are being invested in?
Okay.
So, is it enough to invest in? Is investing in an ESG actually making these companies better?
So what are those figures now that you've pulled them up, John?
Okay, so this is the FTSE for good. It's a UK one, so you're probably best comparing it to say the FTSE 100 over the same period. But from October 03 till now, it's done 161% as a return. And if I just quickly add in the index.
Yeah, totally. Get some cold hard figures on that one for comparison.
Yeah. Versus the FTSE 100 over that same period, say.
Yeah, there we go.
FTSE 100 over that period has done 258% compared to 161% for the FTSE.
Okay. So slight compromise there.
Yeah, I'd say particularly when we're looking at UK, it's going to be around oil and gas and British American tobacco, British aerospace. We're losing out on those companies, which are quite big constituents of the FTSE.
Yeah, got you.
So that's where the FTSE for Good is an ESG plus ethical screening fund, and it will lose out during those periods. But there's been periods of outperformance during that time.
Yeah, but there you go. I mean, is what you're saying there is basically, is it a fair comparison on when you're talking about that specific index? Because most of the FTSE is flipping legacy companies from however long ago, mining companies and all these ones that tend to not be looked upon so favorably by ESG investors, and hence don't make the cut when it comes to that particular fund. So it's an interesting one. It's one of those things, it's really hard to make science on something like this because there's so many variables, and just things to consider. So obviously when we invest in these ESG funds and we feel like we're doing good for the environment and we feel like we're supporting these companies that are ethical, they're here to help, here to make the world a better place. But would you say that it's actually fair to say that when we purchase these, that our money is going directly to these companies and it's being put to good use?
Well, at the moment, there's a really big debate about this. Because ESG has exploded over the last couple of years, there's big debates around how much of it's greenwashing. So there's a lot of investment management funds that have just renamed their fund and put ESG in it because most of the funds within it were okay for ESG purposes, but the actual content of the fund hasn't changed, and they're not actually doing anything from an engagement perspective either. So I think this is where the values thing really comes into it when we're talking with a client about why are we wanting to invest this way? Because if we're wanting to avoid things because it impacts on our ethics, then absolutely we 100% want to avoid these things. But if we're trying to actively make companies better, I think there's a really strong argument to say that index investing in the general market is as good as a pure ESG approach. Because when an index investor, the biggest index investing company in the UK is Legal & General. They're the biggest shareholder on the FTSE. When they're buying these shares on behalf of their investors, they're buying them knowing they're not going to sell them. So what do they do when they're on their earnings call with Shell and the shareholder, AGMs? Well, they vote with a long-term mind. They vote with an ESG mind. It was index investing companies like Vanguard, like Legal & General, like iShares, who pushed for decarbonisation within companies like Shell and pushed them for this climate action. What are you actually going to be doing about it? Because we're still going to be holding you in 50 years' time for our pension investors. So I think there's a really good argument to make that investing in a general index portfolio, if you've got the right index providers, is as strong and is going to have as strong an impact as an ESG portfolio, because they're still going to be driving that change in those companies. But you will have investments that maybe conflict with your ethics. And that's where we have this. We don't really do much pure ESG. We do the socially responsible, where we're saying we'll move all these ones that conflict with our ethics out, as well as have the ESG in there, or we'll go traditional. We do have a couple of clients who've chosen to go down the ESG route, but mostly it's the socially responsible or traditional, or a mixture of those two.
Awesome. Okay, cool. So really, really, really nice roundup or summary of ESG investing there. Just to put a cap on everything that we said today, short and sweet, powerful and punchy, tidbits of advice for anybody who wants to have more exposure to ESG in their portfolio. What can they do? How can they go about it? What are the things that they can do to investigate these funds, at least to a cursory level, so that it's something actionable that people can implement?
Yeah. So if you want to know whether the funds you're investing in have what their ESG ratings are like, there's 3 tools provided by MSCI that we use that are free. Okay. So again, I'll send you the links and we'll pop those in the show notes. One of those is to look at companies. One of those is to look at indexes. And one of those is to look at funds. And you can then drill down into your funds and see what the pros and cons are. So if it's something you really care about, you can look at them and see what's happening. With all of this stuff, just have your own philosophy about how you want to invest. Do your research and then stick to it. Don't go into ESG because it's the latest fad and the newspapers are telling you it's doing great. Because the more we follow the wind, the more we're going to get blown over. Okay, we want our philosophy, we want to stick to it, know why we buy things, and then you'll know when it's time to get out of them. So I that's why I'd go values over doing it for profit.
100%. And the media, they don't do investors any favors really, because it's made out like it's this supposed to be this flipping frantic high energy thing where you're jumping into this fund, you're jumping out of this one because the world has changed and now we need to do this, or this is a current trend. Like, you know, when you see on I'm not going to name any names, but certain financial literature institutions that I'm subscribed to in my mailbox, I don't even know why sometimes, because I don't read the stuff that they send me. It'll say things like, is now the time to invest in uranium and stuff like this.
Yeah,
You're just
yeah.
like, that's just so stupid. You know what I mean? As if now is the time to go ahead and jump into it. Whereas, I mean, for me, even if you did buy some uranium, right, and you made more returns on that than you might have expected, you would have done otherwise. The thing about it is you have to actually think to yourself, at what point am I going to take the money out of this to actually realize this gain? Because chances are it's going to rebalance, or it's the rest of the market's going to catch up due to the law of averages. That tends to be what
reverts
happens.
to the mean.
Yeah, reverts to the mean. There you go, right? And then for me, right, if you're doing that and you're jumping in because you're getting swept away in the wind, just as what you said earlier, or you're getting caught up in this tidal wave of frenzy for this particular asset, right? What's the end goal? What is the end goal? And realistically, if you're not going to do that, it might have been easier just to use the tried and tested techniques to buy the market or buy the average, because realistically for you, that would be the best thing to do in the long run, because you don't have the time to have these more short-term jumping in and out of the market strategies. And all I would, and I'm not, this is not me saying that, you know, don't invest in ESG and don't do all of these things. What I am saying, it kind of aligns with what you're saying effectively, is that if you're going to do it, stick to your guns, find a fund that works for you, okay, and then have it as a portion of your portfolio. And then what that means is that you can consistently invest in it and see some returns that are more aligned with your beliefs, rather than jump, just as we were saying earlier, this frantic buying frenzy, you're getting
This
swept
is where
away.
the values thing becomes really important, because if you're in that FTSE for good and you've lagged the market, but you know you've done it without conflicting with your values,
Yeah.
would you have wanted those returns in the first place if it's from the things that you can't stand?
Yeah. Well,
No, you
that's it.
wouldn't. So you have to be happy with the returns you get because it's stuck to your values. If it's not your values, then don't go down that road, because it's, you know, you're going to be restricting your investment criteria needlessly. So that's why we have this kind of half and half. Some people, they really value it. Some people, they don't. Our ESG, socially responsible stuff, very, very broad. You know, it's got 8,000 holdings compared to 10,000 for the wider market ones. So it's not like we're completely narrowed at the focus of the portfolios.
Got you. Really interesting though that that's a conversation that you have with every single client. I had no idea that things had developed to that level.
Might just be me, mate.
Oh, that's cool. That's cool. Yeah.
Yeah.
Well, here's the thing. Even if it is just you and your practice, it's still really cool. You know what I
Yeah.
mean? I had no idea, certainly, that it was that far along. But yeah, food for thought. John, thank you so much for your time today. If anything that you have said has interested anybody in the podcast who's been listening to the podcast, where can they find out more about you?
My Twitter and Instagram is just juniper_John. You can find me on LinkedIn, or our website is juniperwealth.co.uk.
Top stuff. John, thank you so much for your time today. Interesting episode in ESG investing. We'll catch up really soon.
Yeah, great to speak.